Now, Bob Janjuah is co-head of Global Macro Research and head of Tactical Asset Allocation at Nomura. I'm pleased to say that he's been good enough to join us for the entire hour. And in that time, really going to sink our teeth into all of the big stories of the day and what is going to move markets in the future as well. Just want to give you a taste of where he stands. Now, of course, Europe very much on the agenda. Bob says that Greece could be heading for a default at the start of the new year, and that's going to force the ECB to become the lender of last resort. Bob is cautious on the US. He says growth will come in below trend in 2012 and don't rely too heavily on China. It's not an unstoppable locomotive of global growth. And as for investing, well, his price target for the S&P 500 is 35% lower than its current level. Overall, he says equity markets will lose up to a quarter of their current value. And as I said, we're going to dig deeper into all of these during the course of the hour. Just want to ask you a little bit then about some of your comments just there, and specifically with regards to the S&P, 35% lower than the current level. That's the sort of target that you're looking at. Why is that?
I guess I'm not as bullish, or we're not as bullish as people are becoming on the US economy. We're going for a trend, not the house view, but my view within the global macro team, trend growth number in the US around 1 to 1.25. The optimism now is based off of a cyclical pop that we were long expecting post the Japan sell-off. And so I think as we head into New Year, weaker growth is going to be a focus for the markets, weaker earnings, but in particular, I think much higher levels of volatility. All of these things together are going to, I think, in terms of valuation speak, $90 earnings for the S&P and a 9 PE. Is what I'm looking for. Yeah,
I mean, I think you've alluded to the fact that you think we just had perhaps a temporary surprise to the upside, if you like, with regards to US economic data, because we did have third quarter GDP growth coming in a little bit better than expected. You know, if you cast your mind back to a year and a half ago, many economists are saying that a double dip in the US is almost imminent. I mean, that didn't materialize. So actually, could we see something perhaps a little better than your scenario suggests come 2012?
I'm not calling for a recession in the US. No. I think 1.25 is what I'm looking for. Could there be upside risk to that? For sure. We may not be as bullish as possibly we should need to be on the US. I think the other factor, though, for us is that the likely fiscal drag that we expect in Q1, Q2, my expectation is that the payroll tax and the extended unemployment benefit tax do not get extended into next year. That's a big drag on growth for the first half of next year.
To what extent will that increase the probability of a double dip?
I think if those two things come through, i.e. we don't get extensions of unemployment benefits and payroll tax, then I think we could be flirting with recession. The base case view is slow growth, 1 to 1.5%.
We're seeing a rally in European markets at the moment. But would you be comfortable enough to say that the acute phase of the debt crisis may have passed, or do you think it's still to come? Do you see bargain valuations out there? And if so, where would you put your money?
Look, I think the worst is ahead of us. I think the first half of next year is going to be pretty tough for people. I do think we're going to have a hard default in Greece, which is not, I think, in the market. The ramifications into the banking sector are going to be pretty big. And I think the risk of more than one country actually defaulting in the Eurozone next year is relatively high.
All right.
The next favourite, so to say, is Portugal, I think. So, yeah, I think the joy that exists today, I think it's going to be short-lived.
So you're not too optimistic. And then you mentioned the ramifications on the banks. And there's been a great deal of debate about this. And it doesn't just seem to be an economic or a financial issue. It's something that has been very political, and especially in this country, a bit of a political hot potato, if you like. And so many people asking the question about whether or not banks are a cure or a curse for the global economy. Where do you stand on that?
Well, at the risk of annoying everyone in the banking industry, I think the banking sector is an enormous problem. So the curse, I think. We lectured Japan for many years about taking the hit, moving on, and we criticised Japan for keeping alive zombie banks. We're pretty much doing the same in the West, which to me guarantees that sustainable growth is not around the corner.
No.
It's a long way away.
And they've really been coming under pressure recently, haven't they? Because we're anticipating the ECB to really extend liquidity measures to banks, probably at some point next week. And then, of course, we've got Eurozone banks borrowing more than 8 billion euros from the ECB overnight on Thursday, and that would be the highest level in a fair few months since March. What does this tell us about the strain in financial financial markets right now, particularly when it comes to in the interbank lending market?
Look, I think the issue is the same as 08. We don't know what's in the bank balance sheet. No one believes what the banks tell us, rightly or wrongly. It's not my judgment. But what's clear is that by persisting with the model that we've had, there's a grotesque misallocation of capital going on, away from the parts of the private sector that could use it, into parts of effectively now the public sector, where capital's being destroyed. I work in the industry, and I hate to see it, but I think until the banking system is addressed properly, which can't happen overnight, I accept that, but until we deal with that, real private sector recovery is not going to happen.
Who needs to address that and how?
I think in combination of the banks themselves, the regulators, governments, policymakers. I know it's sort of considered sinful to say that we should maybe let some banks default, but maybe we should let some banks default. Likewise, maybe we should let some countries default. I think the idea that because of Lehman and the Lehman event, because of that we should never let anything default,
but
that's wrong.
Bob, I guess the concern is that this time round, if we do get a big financial institution going bankrupt, if we do see a country defaulting, the effects on GDP, the resulting economic contraction will be far worse than the events after Lehman.
The hit would be more immediate. Over time, would it be far worse? I'm not sure.
Okay.
The comparison is Japan versus non-Japan Asia. Japan didn't take the hit. 20 years on, we still talk about the lost decade. Lost 2 decades now. Asia effectively went bust in 97, 98, took the hit, and 15 years on, Asia is the centre of the world's wealth creation. Who was right, who was wrong?
So you wouldn't advise your clients to invest in banks right now?
There is nothing on my investment horizon which incorporates either bank debt or bank equity.
Going forward, how do you think the landscape of the banking industry is going to change? Are we going to see something more slimmed down, more consolidated?
Yeah, look, I think the regulators actually, their end game, I think, is give or take right. It's a banking sector which services the real economy. I think investment banking is going to go more the partnership model, non-systemic. And I think the old joke that we used to have in banks, 2-4-2, borrow at 2, lend at 4, golf at 2, I think that's coming back. It's going to take some time, but the banking sector, I think, is essentially going to become a utility type setup. Not something that's so self-serving and got us into partly got us into the mess that we got into in 07, 08.
And of course, this week we saw S&P downgrade a whole host of big banks. I mean, it just reads like the who's who of Wall Street, and also some pretty big institutional names right here in Europe. Interestingly, they did upgrade some Chinese banks.
Sure.
So how do you see the future of banks in the emerging world evolving?
Yeah, look, I mean, I think these banking entities, a lot of these banks are flush with capital and liquidity. They're meant to be opportunistic and pick and buy stuff if they're allowed to. But I think the reality is that what happens in the Western banking system is still going to drive the market for the foreseeable future. And I think in that context, what's very clear is that governments are going to have to separate themselves gradually from the banks, because the banking sector risks threaten taking down governments.
But if you look at what's happened over the past few years, one might say that the future of shareholding in a bank, I mean, it could be just that. It could be nationalization. You know, could we actually see the situation go the other way?
We could. I'm not sure how many countries can do that. I think, for example, if in the UK government were forced to nationalise one or two of the obvious candidates, the risk to the UK government's rating would then be very real. And then the whole fiscal monetary plan that we have in place in the UK would fall apart. So I'm just not sure whether nationalisation is going to be that easy or obvious a route.
So we've spoken a great deal about the outlook and events of the past year as well. What does all this mean for prospects going forward? What is the one big geographical area or country or asset that you are focusing on? You know, give us a fantastic investment play for next year.
Look, I think it's about safety, it's about preservation of capital and income. Kevin and I both like non-financial big cap corporates, both from a debt and equity perspective. Not because I think their equities are going to double or triple or anything like that, but the big cap corporate sector is global, doesn't worry about a weak growth phase in any one particular region. Most of these companies have incredibly strong balance sheets. They don't need funding. In fact, some of these companies are funding central banks these days, right? I think in these companies we're going to get a lot of special dividends, bigger dividend payments and stock buybacks. Because essentially, I think these guys are going to figure out the world has gone ex-growth for a few years, and rather than sitting there with $70, $80 billion of cash on your balance sheet, which is destroying your ROE, use the cash, buy back your stock, give it to the shareholder, and let the IRS come after the shareholder rather than coming after the company with the cash balances.